In the vast and complex world of economics, where countless indicators vie for attention, few numbers resonate with as much significance as two key metrics. These are the Consumer Price Index, CPI, and the Producer Price Index, PPI. They are fundamental tools for understanding the economic landscape. The CPI meticulously tracks the average change in prices over time. It serves as a barometer for the overall cost of living. It measures what urban consumers pay for a representative basket of goods and services, a collection carefully chosen to reflect typical spending habits. This basket includes everyday essentials like groceries, the fuel you pump into your car at the gas station, the rent you pay for your apartment, and the ever-increasing costs of healthcare. These are the things that impact our daily lives. As such, the CPI is the main measure of inflation, the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. In essence, it tells us whether your dollar buys less today than it did yesterday, highlighting the erosion of your money's value over time. It's a critical indicator of economic health. The PPI, meanwhile, offers a different perspective on price changes. It measures the average change in prices received by domestic producers for their output, providing insights into the costs faced by businesses. This includes everything from raw materials like steel and lumber to essential manufacturing components and various industrial supplies. It also encompasses the prices of finished goods ready for sale, offering a comprehensive view of the production pipeline. A rising PPI often signals that higher costs are coming down the line for consumers as businesses pass on their increased expenses. This makes it a leading indicator of inflation. These indexes matter profoundly because they influence everything from the amount you pay on your grocery bill each week to the Federal Reserve's critical decisions on interest rates, which in turn affect borrowing costs for everyone. When the CPI rises, your purchasing power drops, meaning you can buy less with the same amount of money, impacting your standard of living. And when the PPI rises, businesses face tough choices about how to manage their bottom line, forcing them to consider raising prices for consumers or implementing cost-cutting measures that could affect product quality or even jobs. The Federal Reserve, the central bank of the United States, watches these numbers closely, analyzing them with sophisticated tools and models. They use this data to make informed decisions about adjusting interest rates and implementing monetary policy, all in an effort to keep inflation within a healthy range and promote economic stability. Each monthly CPI and PPI release is a closely watched event, sending ripples through financial markets and influencing economic forecasts. It's more than just a set of numbers. It's a preview of decisions that will ultimately impact every American's wallet, shaping their financial well-being and future. The Bureau of Labor Statistics builds the CPI by tracking prices for a carefully selected basket of goods and services based on detailed surveys of consumer spending. Every month, thousands of prices are collected from stores, service providers, and landlords nationwide. The PPI, also from the BLS, surveys businesses to track the prices they receive for their products, from raw materials to finished goods. The PPI isn't just one number. It includes indexes for final demand and for intermediate goods, letting analysts spot where price pressures are building. A spike in raw material prices can signal higher consumer prices ahead. Together, these indexes reveal how inflation moves from producers to consumers. As of July 2025, inflation remains stubborn, with the CPI up 0.3% for the month and 3.4% over the past year, still above the Fed's 2% target. Services like housing and healthcare are driving most of the increase, while goods prices are flat or falling. The PPI rose 0.2% for the month and 2.5% annually, suggesting business cost pressures are easing somewhat. Both reports show a clear split. Goods inflation is cooling, but services inflation remains sticky. Supply chain issues have faded, but wage growth and a tight labor market keep service prices high. This makes the Fed's job of controlling inflation more complicated. When the CPI, or Consumer Price Index, rises, it signals a broad increase in the prices of goods and services across the economy. This isn't just an abstract number. It has very tangible effects on your personal finances. Think of it as a measure of how much more you're paying for the same basket of goods and services over time. As the CPI climbs, your cost of living goes up, sometimes subtly, sometimes dramatically. It means that the money you earn buys less than it did before. Groceries, those weekly essentials, become more expensive. The same items you used to purchase for a certain amount now cost more, forcing you to either cut back or spend more. Gas for your car and rent for your home all get pricier, putting a strain on your monthly budget. Transportation and housing are significant expenses for most people, so increases in these areas can be particularly painful. And with rising prices across the board, your paycheck doesn't stretch as far. You might find yourself having to make tough choices about what to prioritize. High inflation erodes savings, as the purchasing power of your money decreases over time. The money sitting in your savings account is effectively worth less as inflation rises. And high inflation makes it harder to plan for big goals like buying a home. Rising interest rates, often a response to inflation, can make mortgages more expensive, putting home ownership out of reach for some. Or retiring comfortably. Inflation can significantly impact retirement savings, requiring individuals to save even more to maintain their desired lifestyle in retirement. Social Security benefits and some wages are tied to the CPI through cost of living adjustments, or COLAs. These adjustments are designed to help offset the impact of inflation. So higher inflation can mean bigger checks from Social Security or a wage increase from your employer, as these payments are adjusted to reflect the rising cost of living. But it also means higher expenses across the board, potentially negating the benefits of those increased payments. It's a bit of a balancing act. The PPI's impact, or Producer Price Index, is less direct for consumers, but just as real. It influences the prices you pay in the long run. When businesses face higher costs for raw materials, energy, and labor, these increased expenses affect their bottom line. To maintain profitability, they often pass those increased costs on to you, the consumer, in the form of higher prices. That seemingly small price hike on a new car or a can of soup at the grocery store often starts months earlier with rising producer costs, rippling through the supply chain before hitting the shelves. Persistent inflation forces families to save more aggressively to offset the declining value of their money. It also encourages them to take on more investment risk in search of higher returns to outpace inflation. Or it may force them to delay important financial goals, like purchasing a home or taking a long-awaited vacation. Ultimately, both the CPI and PPI indexes play a significant role in shaping your daily spending habits and financial decisions. They also have a profound impact on your long-term financial security, influencing everything from retirement planning to investment strategies. Therefore, understanding these indexes and how they work is essential for making smarter, more informed money decisions and securing your financial future. For businesses, a rising PPI means higher production costs and squeezed profit margins. Companies must decide whether to raise prices, risking lost customers, or absorb costs and cut back elsewhere. Persistent inflation creates uncertainty, making it harder to plan investments or expansions. This can slow economic growth and job creation. Employees feel the pinch too, pushing for higher wages to keep up with living costs. But raising wages can fuel a cycle of higher prices known as a wage price spiral. Inflation challenges both business strategy and workforce stability. The Federal Reserve's job is to keep inflation around 2% while supporting employment. CPI and PPI data are central to this mission, guiding decisions on interest rates. When inflation runs hot, the Fed raises rates to cool demand, making loans, mortgages, and credit more expensive. Fed officials look beyond headline numbers, focusing on core inflation that strips out volatile food and energy prices. Persistent services inflation tied to wages and labor markets is especially concerning. The Fed's challenge: figure out where inflation is coming from and whether it's likely to stick around. Every CPI and PPI report shapes the Fed's next move. The Federal Reserve's decision-making process is far more intricate than simply reacting to the latest consumer price index, CPI, or producer price index, PPI figures. It's a comprehensive evaluation, a deep dive into the multifaceted dynamics of the economy. The Fed meticulously weighs a wide range of data, far beyond just inflation metrics. They analyze indicators from various sectors to get a holistic view of the economic landscape. This includes a close examination of jobs and wages, scrutinizing employment statistics, unemployment rates, and the overall health of the labor market. They look at wage growth trends to understand the pressures on businesses and the spending power of consumers. They also pay close attention to consumer expectations, gauging sentiment through surveys and analyzing spending patterns. Consumer confidence is a key driver of economic activity. If people expect inflation to stay high, it can become a self-fulfilling prophecy. In anticipation of rising costs, they may demand higher wages or raise prices on goods and services, creating a feedback loop. This makes inflation harder to control and can lead to a sustained period of economic instability. The Fed also considers that its actions take time to work. There's a significant lag between policy implementation and its effects on the broader economy. For example, rate hikes can take months, even quarters, to fully affect the economy, influencing borrowing costs and investment decisions. Policymakers must balance the risk of doing too little, potentially allowing inflation to become entrenched, and letting inflation persist, eroding purchasing power and destabilizing the economy. They must weigh this against the risk of doing too much, overreacting to inflationary pressures, and causing a recession, leading to job losses and economic hardship. Their decisions are always about carefully managing these competing risks, navigating a complex economic landscape. The ultimate goal is to keep inflation in check, maintaining price stability for consumers and businesses alike. They aim to do this without derailing economic growth or causing widespread job losses. It's a delicate balancing act, a constant effort to steer the economy towards a path of sustainable prosperity. This balancing act has real consequences for everyone, impacting families, businesses, and the overall well-being of the nation. As the September 2025 Fed meeting approaches, the debate is intense: raise rates again or hold steady. Those favoring a pause point to falling inflation and argue that previous hikes need more time to work. They see easing supply chains and stable PPI as signs policy is working. The hike camp worries about stubborn services inflation and a strong labor market fueling wage pressures. They argue a final rate hike may be needed to anchor expectations and finish the job. Some suggest a hawkish pause, holding rates but signaling more hikes could come. The Fed's credibility and the economy's future hang in the balance. The Fed's decisions directly affect your finances. If rates go up, borrowing costs rise. Mortgages, car loans, and credit cards all get pricier. If you have variable rate debt, your payments could jump. Now's the time to pay down high interest debt and consider locking in fixed rates. On the flip side, higher rates mean better returns on savings accounts and CDs. Shop around for high yield options to make your cash work harder. Stay informed. Watch CPI, PPI, and Fed signals to guide your borrowing, saving, and investing. In a changing economy, knowledge is your best financial tool. Please like, comment, share, and subscribe.